Good morning, and welcome to the Energy Prospectus Group webinar hosted by Riley Exploration Permian. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here is Dan Steffens, who will introduce today's host company.
Yeah, welcome everybody, and thank you for attending this webinar. It's being hosted by Riley Exploration Permian, which is a recent addition to our small cap growth portfolio. Riley Permian is an upstream oil and gas company with headquarters in Oklahoma City. The company's current activities are focused on horizontal development of their leasehold in the Northwest Shelf area at the northern part of the Permian Basin, right next to New Mexico. As of September 30th, 2021, which is the end of their fiscal year, the company's proved reserves were 72.2 million BOE, with approximately 64% being crude oil. During Riley Permian's most recent fiscal quarter that ended December 31st, they just announced on Monday, the company's production was approximately 9,900 BOE per day, split 75% crude oil, 15% natural gas, and 12% NGLs. Their guidance for this fiscal year is 11 to 15% production growth. What drew my attention to the company after one of our members alerted me to it was the company's focus on the horizontal development of their San Andreas formation in West Texas. And when I worked at Hess from 1983 to 2001, the seminal San Andreas unit was a CO2 flood that we had, and it was our highest producing asset in the world for the whole company, with peak production of about 64,000 barrels per day. Riley Permian's management believes that their primary asset in Yoakum County, Texas, has significant potential for CO2 flood. Joining me on the webinar today are three members of Riley's management team are on the call: Bobby Riley, chairman of the board; Kevin Riley, president; and Philip Riley, Chief Financial Officer. I'm not going to go into their backgrounds now. You can find detail of each gentleman's background on the company's website. Before we start the presentation, I want to remind everybody that if you have any questions, please type them into the chat box. I already have 10 questions that were sent to me via email. So at the end of the presentation, I will come back on and we will have about 30 minutes of Q&A. And now I will turn it over to Kevin Riley, the company's president. And Kevin, I think you're muted. You need to unmute there.
I can get us started here.
Okay, Philip, go ahead.
Quick SEC disclaimer. Obviously, we're going to have some forward-looking statements. These are, subject to SEC rules and such, the standard that you'll see elsewhere. There we go. Kevin, you still on mute? I can take us through if not. All right, so our overview here, we are a growth-oriented independent oil and natural gas company. We're headquartered in Oklahoma City, and we are focused on the horizontal development of the San Andreas formation, as Dan was saying. This is a conventional reservoir. It's on the Northwest Shelf of the Permian Basin. Our acreage is primarily in Yoakum County, Texas. We love the asset. It's not shale, it's conventional, which gives us low base decline production. In turn, that makes it less capital intensive and allows us then to really allocate that capital for other matters like dividends and debt pay down. We're a public company as of the last year. We were formed in 2015 through a couple of private equity groups coming together. But last year we did a reverse merger and went public. And so we are now public with about 19.5 million shares. We've got a market cap of approximately $500 million, a small amount of debt, less than 0.7 times leverage. About a third of that stock is held by one group on the board as well as management. And then we pay a nice dividend with about a 5% yield. Our strategy is simple. We want to steadily grow cash flow from operations through development of existing assets and then continuous improvement of everything we do. I'd emphasize here the growth is on cash flow. It's not just on production. We may want to grow production and may want to do that for several years, but that's not our overall objective. The objective is to focus on cash flow. At the same time, we want to identify new opportunities for capital investment. That may be other oil and gas assets similar to ours. They may be slightly different, or they may be new ventures, including some carbon capture opportunities that we'll talk about in a few minutes. And then finally, we want to distribute excess returns to stockholders in the form of dividends. This page gives us a view of our asset here. It's this field called Platang. We call it Champions internally. This is sandwiched between two giant legacy fields, the Wasson and the Braheny. Those have been producing for 100 years. This field, the wells, the depth is about 5,000 feet. That's about half the depth of what you'll find in these shale Delaware Basin Wolfcamp wells. And so that lower depth allows for less expensive drilling. And then at the same time, it's a conventional reservoir with natural permeability and porosity. That allows for natural movement of the volumes through the rocks and such, so therefore we don't have to frack these wells as hard. We do frack them, but it's a less intensive frack and then also less expensive. We've got about 26,000 acres in this area between these two, and this was just never produced historically like these other two Wasson and Braheny fields were. Those have been produced originally through primary production, and then subsequently with water flood, and then even CO2. And in total, these have produced over 2 billion barrels. So it's pretty exciting structure in here and gives us a lot of confidence on the running room with our asset. Page 7 here illustrates a few different things. On the left third, it illustrates maybe the first 3 years of a couple different types of wells, one of our, like a composite of our type of well, comparing that to shale, and shows you how it starts, even just here, how a shale well really declines pretty fast, and you're down to say 15% of peak production after only 3 years, whereas we're still up at 40%. And then after that, I really should be showing more here. It's really a nice flat baseline, lower decline. And so what that in turn enables is a distributed use of capital, where we're really only investing maybe 70% of the capital and still growing. These figures show fiscal year last year. We reinvested about 70% of capital, and we still grew 22% year over year. You'll see other companies now investing even less after many years of kind of overspending, outspending cash flow and growing like crazy. Clearly other companies have dialed back. The big ones are growing less, and you may see some of them spending even less than what we're spending here. But I'd point out that they're not growing, and that can make a big difference in how you think about the future for cash flow. Clearly, their cash flows, a lot of them are going to be growing this year as a result of just improved pricing. But we do think we've got a really nice runway here with our growth profile compared to others. At the same time, this leaves about 20% of cash available for dividends. And we've been paying those out for many years. We're not a new dividend payer. We've done it for over a dozen quarters now. And then finally, there's leftover, and we use that to pay down debt. Last year, going forward, we can decide how we want to use that capital. There's a case to be made that our leverage levels are low enough, and we could use the capital instead to either grow more or do some add-on acquisitions or do other kinds of new ventures like the carbon capture and such. Page 8 gives a snapshot of how we've grown. just over the last 5 years, even really almost from a base of nothing there. Back in 2017, we're at under 2,000 MBOE a day. We've grown up all the way over 8,000, near 9,000, 10,000 more recently. And this also shows how EBITDA has grown in lockstep with that production, despite all the volatility that we've seen in oil price. I think we've all unfortunately lived through that. The right hand of the page shows some of those bars. We take for granted how high and low it's been, but even aside from 2020, we had big ranges, $20, $30 ranges in price there, but really bumping along in that $40, $50, $60 range. And we were still generating this kind of EBITDA and cash flow. It also gives you a kind of a preview, sneak peek of what's to come. If we can make this kind of cash flow at those prices, then we're excited about what's to come in the future. Page 9 gives a kind of a stair-step view of how we've added to our reserve base over the last 5 years. You don't see people talk about this as much anymore, but we're kind of old school and like to think about the resource in this perspective, where you've got proved reserves and you add to those and take away each year through your production. And the dark green bars here represent the ending proved reserves, and those are done by Netherlands Sewell, arguably one of the most respected groups out there. Reserve estimates can be subject, obviously, to different interpretation and estimates, but we believe Netherlands Sewell is among the more conservative and most respected. So we think these are solid numbers. The lighter green then represents additions each year. You can see, for example, during 2019, we added 29 million barrels equivalent. That was in a large part due to some aggressive development during that year and additions being added as that field was being appraised. In 2020, we really just brought on very few wells, maybe 3 wells. We spent some money and didn't even complete others. And so the reserve addition was less, and yet we still added on more than we produced during that year. And then last year is a nice example of kind of a return to what we hope is the norm, where we're really adding much more than what we're taking away. And then you look at this big picture, with ending reserves of 72 million barrels equivalent versus the starting, we're up 5x in 5 years. It's a pretty exciting trend for us. As a little bit of validation there, our borrowing base with our bank increased back in October about 30%, from 135 million to 175 million. And approved PV10 value you can find in our 10K is going to be over $500 million. Page 10 gives some illustrations of kind of what we call a cash conversion. This starts with a cash margin, which is effectively our revenue net of hedges and the net of some cash costs. That's operating costs, some cash G&A, production taxes, and so forth. And that was about $27 per BOE. That includes gas at 6 to 1 and NGLs at 1 to 1. And you can see how we compared this to other Permian. Some guys talk about costs only on a BOE basis, but if you include the revenue too, you can see how that nets out, and we've really been ahead of many others. This is a hedged margin, and so it is lower than what we've seen recently. We're hoping that's going to be increasing here materially in the coming quarters. And then our cost to add reserves, this is a capital metric, but we've averaged $6 per BOE over the last several years. And I challenge you to find another company that has something even near that number. We took an average of all these guys, and we're not cherry picking here. We're including the big boys, Pioneer, Diamondback, the super basin masters here. And an average of all these guys was about $14 per BOE. So really excited about that strength, and that shows the capital efficiency of what we can do with this asset. You combine these two, you take the 27 divided by the 6, you got a 4.5 times cash conversion metric, and you see how that's far and above the other companies here. Page 11 speaks to our forward look on hedging. We recognize the company's been significantly hedged. That was a real boon to us during 2020 when many companies weren't, and we were able to enjoy that nice improvement in EBITDA even in 2020. It came to bite us last year as we were hedged at some lower prices and we had such a fast and violent rebound. Those hedges are starting to roll off, and we're working hard to manage this and revise the strategy to be less hedged going forward. These percentages here, we haven't given total guidance for all of the future. And so what the percentages here represent are just a percent of the hedge volumes relative to our most recent quarter, the fourth quarter actual 21 production actually. And you can see how that starts to trend down here over time. So it's not only a function of what your hedge price is, but how much exposure then you have to the market and then what that market price is. So clearly the green aspect of this is growing over time. Maybe it's just a third these first few quarters here, but then in the mid 40% for the back half of the year, and then clearly kind of in the 2/3 to almost 80% for next year. At the same time, we're trying to manage the backwardation. So we've got obligations to hedge with our credit facility. And that includes a 24-month look out. But we try to manage that by hedging more closer and less further out. And we're starting to use some wider collars here so that we're not subject to the swap price, which may be in the 60s or something, in case we continue to experience this roll aspect with the spot versus the future price. So as an example, we just put on some collars recently. Those were a floor of $45, ceiling of 115. So that gives us a whole lot of range there with our hedging. Page 12 takes us to kind of a view of how we're thinking about new opportunities for investment. Standing back for a second, we are supporters of the oil and gas industry, but we recognize there's increasing dialogue across our country and planet about decarbonizing economies, and we try to think about the impacts of that on our business. When we stand back, we understand and see that we produce one of the most highly demanded and valuable commodities in the world, clearly. Society uses it across all kinds of aspects of everyday life. And that is heavily demanded. So on the one hand, we do believe that investing in oil and natural gas assets will continue to be an attractive opportunity for many years. And we will look for opportunities to increase our scale, further improve our cost structure. Based on what we were talking about with hedging, we see the price improving, we see the supply and demand backdrop improving. We do believe we'll experience volatility, and we want to remain flexible there, but we do see a constructive supply and demand backdrop, partially because many companies are shifting capital away from oil and gas. And most notably, that's happening at the majors, which I'm sure you're all familiar with. But you've got these massive companies, Shell going towards such electrification, BP shifting so much capital away, and that will really start to move the needle on oil and gas, which is a declining asset if you don't continue to reinvest in it. So you're really starting to see that, and that's creating this kind of interesting supply-demand backdrop. At the same time, and then focusing on the right hand, we are looking for complementary new assets and ventures. So we're paying attention to this transitioning energy landscape. We're looking for opportunities in which we could make good economic projects. We're not going to do something for greenwashing effects, but where we can make good returns. And an example of that is our work with carbon capture, utilization, sequestration, CCUS or CCUS. We believe that our asset, based on certain characteristics that I'll go to in a minute, really well positions us for that. And so I think ultimately, big picture, we see benefit in providing energy that's both low in cost, but also low in carbon intensity. And so if we could create a barrel of oil that's, say, lower carbon than something else, someone else, then we do see potential for that to be a differentiated barrel. Maybe one day somebody pays a dime more for that, or $1 more for that, and more we see potential for kind of a premium to potentially exist in what has historically been a commodity product. This is a busy page, but gives you kind of a snapshot of both where our asset is relative to a lot of CO2 pipelines, pipeline infrastructure, but then also emissions. And what's interesting about this is that it gives a view of how we can participate in this play. So we see it as having our asset, based on where we're located there in the kind of Northwest Texas, is giving us both a geographic and a geologic rationale for both EOR, the enhanced oil recovery, and then also the carbon capture. So starting with the EOR, the infrastructure, all these blue pipes, you see that we're in the area with the most concentrated area of all this CO2 pipeline infrastructure. And that was developed decades ago to support very much the fields that are across the fence line from us that I described toward the beginning of the presentation. Those were put in place, and they bring CO2 in from natural fields that are producing up there, say in southern Colorado. You can see how the pipes reach up into there, and then they're going into all kinds of Permian Basin fields to supply them CO2. So being close to that really allows us, one, a reliable CO2 supply, but also a lower tie-in cost, because building new greenfields can be expensive. So that can be a real head start for us. At the same time, on the geology side, our assets possess similar rock properties to nearby EOR fields across the fence line. Permeability, porosity, oil saturation can be quite similar, and that gives us some confidence that our asset will be a good candidate for EOR. And as such, we started our own pilot program here. We raised capital for it last summer, and we've been building it out. We've been drilling injection wells for it. We've been laying infrastructure pipeline to inject both water and gas into the ground. And we're going to be starting that injection here in the coming months. And so it's something we're excited about, and we're hopeful to have response to report on that should be exciting for the company. At the same time, this all creates a complementary opportunity for carbon capture. So the EOR, the pipeline can be used on the one hand to bring the CO2 for EOR, but it can also be used to collect CO2 emissions from all these industrial plants and take them to different places, both for EOR, but also for permanent storage. So all these little colored green dots represent different types of industrial facilities, electricity plants, cement plants, so forth, that are all around. And clearly you're going to have a lot of those in the Northeast, but you don't have any CO2 pipeline infrastructure. You got quite a bit in the Gulf Coast, and that is clearly a concentrated area of industrial facilities, and you've got some pipeline there, but clearly nothing like the West Texas area that we've got. So we are excited about that opportunity. We're looking at ways we can use that industrial CO2 and use it for our EOR, but then also the permanent storage, in which you've got some favorable tax credits to support the project. Page 14 gives a bit of a glimpse of our dividend history. Several quarters here of doing this, not only paying, but increasing over time. It's something that's important to us as a principle for the company, and we continue to plan to do it. Page 15 gives a glance at some of our ESG highlights. And we try to be good stewards here with our asset on the environmental side. We've installed all kinds of infrastructure for gas, for water, for oil handling. That eliminates the need for truck. It improves our costs and realization. It also reduces truck emissions and so forth, accidents and such. We try to do that before bringing a well online, and we really think that leads to better efficiency. You know, on the social side, we try to be good stewards with our communities, with our employees and so forth. We think we're a good small business for companies to work for. And then on governance, one of our key principles is transparency, creating a sustainable corporation, not in the sense of just environmental aspects, but the fact that this company can be sustainable, creating nice cash flow for the business and for shareholders, returning that, being transparent with what we do, and being aligned with the shareholders with stock ownership and such. So wrapping up, we think we've got an interesting company, attractive opportunity for investment. We got a proven and aligned management team with owning the stock. We've got people from all kinds of backgrounds. We're really proud of the asset we've got. It's a conventional asset, not shale, enabling that capital efficiency discussed before. We've shown our track record on organic growth, cash flow, and reserve growth. Hope to continue to do that in the future. We think we compete with the top E&Ps on some of those financial metrics, the margins, the finding costs. We're excited about the upside with the EOR, the carbon capture opportunities. And then, of course, I think everybody likes the dividends, and we continue to plan to do that. So with that, I will turn it over. I'm not going to go through all the first quarter updates, but I'll turn it back to Dan and open it up for Q&A.
Hey, Philip, good job. I don't know, is Kevin still muted there, I guess?
I'm on the line now.
Oh, okay, Kevin. Yeah, we all have trouble finding that mute key. Anyway, let me go. There's been 2 questions typed into the chat box. I'll get to those first, and then I've got like 10 questions that were emailed to me. So John asked, looking at the chart of Riley, I see there are huge swings in the price in 2020 and 2021. Can you explain what caused those huge price things? And John, I'll first say, I can show you charts for about 25 other small caps, and they all have those same price swings. It was commodity prices going up and down. And then also for the smaller cap companies, because they don't have as much float, you know, it can just be a few guys selling or something causes a sell off. But Philip, you want to add something there?
Sorry, can you clarify the question there?
Yeah, he was just asking on your stock chart, the big swings in the stock price in 20 and
yeah,
21.
so first of all, what I'd say is, while officially, like, you know, I discourage you from looking at the history beyond a year, especially, you know, officially, when you do a merger, the other company's history is your history, but it was a totally different company when you do a reverse merger. I can tell you, coming right into the merger, we had very high volatility. We seem to have gotten mixed up with some of those message board type of stocks where you had crazy swings that didn't seem to be tied to fundamentals and such. That occurred there. And then frankly, during the summer last year, we got added to the Russell 2000 index, which was exciting. But what it ended up doing, you can start and look, it basically happened all during the month of June. And each day, basically there was, you know, some kind of whatever bot or algorithm buying, and it essentially bought more than it needed to by maybe a factor of 10x. And that may have had to do with our reverse stock split. We don't know. This is unofficial conjecture, but that seemed to lead to a big rise up, which was followed by a correction there. Since then, we do have some up and down. You know, what I'd say is our float is smaller. We recognize that. We've got 3 large groups that own about 80% of the company. We did an offering last year for 2 purposes. One was to raise a bit of capital for the Eor Pilot Program. Another was for just increasing the stock float. So the volatility is something we're aware of. You know, we don't love it. but it's out there. We can't control it. And, we'll do the best we can with it.
Philip, how many shares do you have outstanding right now? Like 20 million, right?
Yeah, we have about 19.5 million.
Okay. All right. Then Bill asked, he comments on the hedges here. It's a good slide on the hedges. And then he asked, why don't you just buy puts? And, he asks this on every call, but yeah, you can respond to that if you wish.
Why don't we buy puts?
Why don't you just buy puts and don't put a ceiling on it?
Yeah, puts are quite expensive. Try to buy some puts for a year out or 2 years out, and they'll cost you $6 or $7 or $8 a barrel.
Yeah.
And that's a lot.
And you're doing these costless collars. So if you can get ceilings, like, didn't you say 140 or something?
115. So yeah,
150,
exactly. So
115.
volatility cuts both ways, and that's implied in the,
Yeah.
Anybody wants to talk about Black-Scholes, the pricing of an option. And so puts can be expensive. We explore that, but instead, what we chose to do is do a costless collar. We think the $45 is above our operating cost, gives us some room there, but then gives us cushion. If prices are bouncing along in the 90s, then nothing happens there with that. We meet our obligations for the hedging, but then nothing gets touched there, and we just enjoy the market.
Yeah. I would think collars right now would be the way to go. And then he asks, because last month when the February gas futures contract settled at 626. The question is, how do you settle that? Are you based on the average price for that month, or it's not just on the last day?
Yeah. So gas does last day settles, which is a nuance you seem to be familiar with. It can sting you. I can tell you, for example, we just saw January, and I think there was a 6 handle there on the settle. Gas does have that. It's it is subject to the volatility that much more with your winter summer type of swings and sine curve.
Mm-hmm.
Oil is typically less. It's more of kind of an average, and so you're not going to have that as much. We have a bit of gas. I can tell you we'll probably be hedging even less on gas going forward.
Most of your hedges are oil hedges, right?
Yeah, that's right. It is a nice idea to try to lock in the margin, but it really doesn't drive decision making. And we're going to be doing that. It's a byproduct. It's, we do it for the oil. It's a nice addition to have the gas and NGL revenue, but it's not going to impact our decision. So I would not be surprised if we did less and less.
And Bill, I put detail of their hedges, but split between oil and gas on the bottom of my forecast spreadsheet. So you could find it there, or, just go to their 10Q. Then let me get to a few of these things, then we'll go back to the Champions Field. First of all, are you seeing any shortages of casing, frac sand, completion crews? What's the situation on services out there now?
We are starting to experience shortages in materials and service company availability or delays associated with their availability, which have led to some cost increases or delays that we're currently experiencing, and disclosed one event in our most recent call. But in some cases, we're seeing oil field casing and tubular goods that have more than doubled on a per foot basis cost. And some specialty items having very limited availability. Mm-hmm. Overall, though, with the cost increases that we've seen from inflationary items, when you offset that by our efficiency gains, we probably realized somewhere between a 6 to 8% increase on a very similar wellbore year over year.
Are you guys having to frack these wells in the San Andreas?
Yeah, we're fracking the wells. It's, like Philip alluded to earlier, it's a much less intensive frack as compared to a shale well. Most cases we'll use between 600 and 700 pounds of sand per foot, where you see in some cases on the bigger wells, there are multiple thousand pounds of sand per foot. So with the moderate depth being around 52 to 5,300 feet vertical, the high porosity and permeability, we just don't take as much completion intensity to be able to open up the reservoir to the borehole.
Okay. Philip, did you unshared your screen or something? Because the thing went off. I don't know.
Okay, sorry. I was looking at the questions.
Okay, that's fine. That's fine.
Yeah.
Um,
By the way, I see one now. I understand better the question from John Davis. The price swing, I just want to clarify on page 8, those price swings, that was the market. That's not us. So what you were seeing there was WTI spot. Does that make sense? We had negative $37 and then price.
okay. Yeah, I was thinking he was talking about the stock price charts. Okay.
Yeah, these swings, that's what the world exhibited. And so the purpose of the slide is to say, look at all this stability we created on the left, despite this crazy volatile world we lived through. One other point I'd make is our fiscal year ends September 30th. So that fiscal year 21 included some low prices in the calendar fourth quarter of 2020. So we went from $36 to $76 in a fiscal year, averaged. Again, this is WTI spot, not us. This is the market.
Yeah.
And that's what we're living through.
And, a lot was made out of the futures contract going negative. That was just the traders doing that.
Sure,
in the spot market. I don't even know if it did go negative, but anyway, crazy year 2020.
Yeah.
I've been in the business for 40 years and I've never seen anything like the last couple of years here. So, okay, let's go to the next question. Can you give us more detail on the impact of the temporary shutdown of the company's primary midstream gas gathering and processing partner? I heard that. And when do you expect the shutdown to begin? How much will that impact your production, that kind of thing?
I guess to be clear, our midstream partner is not completely shutting down its gathering and processing facilities. It's rather just curtailing a certain volume as they work to expand their system. We expect the curtailment overall to impact around 20 to 25% of our natural gas and NGL production, not our oil, which those two components of our revenue stream last quarter made up 11%. A year ago that made up 2%. So, I mean, the impact of pricing has certainly helped. The effective date of that curtailment started in early February, and we anticipate that to last until early to mid-April, at which point we think we will be able to put most, if not all, of the produced gas in the Champions field into the system and continue to grow our production out there.
So that could actually increase your production after it comes back online, right?
Absolutely.
Okay. And then will it enable you to sell more NGLs?
Well, effectively, we will have more NGLs because we'll have more volume. Gas that is processed. We produce a rich gas in the field. So we anticipate that, our gas sales could increase 10 to 20% based upon this expansion.
Well, I follow a lot of companies, and I can tell you this spike in NGL prices has been a nice revenue boost for a lot of companies.
Absolutely.
And with you guys can add to this, but there's a shortage of propane. Or propane inventories are dangerously low, actually, and that high propane price is giving all NGLs a nice boost. What was your propane price for the last quarter? Wasn't it like 40 or something?
I think we're about $30.
Okay.
We're forecasting NGL pricing is always really tough.
Oh yeah, it's tough.
Everybody's basket is a little bit different.
Right.
It's like a different cocktail. And then there's fees that are netted out of there. Typically, is the way most people report it. We're happy. We are experiencing similar type of improvement in our pricing, where it was in the low single digits to then teens last year, 20s, and then this last time, a really nice 30% or so of WTI. So we're hoping if oil continues in these kind of mid 80s type of pricing or so, we're hoping we can still continue to get 30-35% of WTI and maybe continue to get a $30 type of barrel of NGL.
Yeah, that's outstanding. That's outstanding, because your NGL price came in about $10 or $11 a barrel higher than what I was using in my forecast. So that really helped.
Mm-hmm.
Anyway, let's talk about the Eor Pilot Project. Okay, if it's successful, you're going to start the water injection now, and I know there's a slide in here. We got kind of a timetable. The water now, and then to let everybody know, you start with water, and then you do alternate with CO2 and water, and that's going to start in the summer. And then what happens next? Then what are you really looking for?
This is Bobby. Let me take that question. Can you guys hear me okay?
Yeah.
Okay, great. So the pilot that we're currently working on, that will be starting injection soon, is basically half of a 960 stand-up unit. It's going to be the eastern half, which means it's about 480 acres. The pilot, what we're trying to determine is how much injectivity, how to optimize the efficiency of the sweep so we don't leave any crude behind. But when we look at this thing from just a resource potential, that 960 acre full unit has about, say, 70 million barrels of original oil in place. Primary production is in the neighborhood of about 7%, which that 960 acre unit under primary, roughly 5 million barrels on a total EUR. Under CO2 and water or WAG program, we're looking at potentially up to 15 million barrels of recovery. So about 3x on recovery. We're going to this relatively early in the life cycle, different from historical where fields produced for 20, 30 years before they went to water flood for another 10 or 15 years, and then CO2. We're sort of coming on the front end of this, and we think we'll maximize ultimate recovery. From an expansion point going forward, I would say that we've kind of identified somewhere around 8 or 9 additional stand-up units that would be suitable for CO2 enhanced recovery. So, stay around 9,000 acres or something like that out of our block. It's not that the rest of the acreage is not suitable. It's just a little thinner, a little tighter, but great primary production. And we've pretty much developed a lot of that acreage. So we see a great expansion opportunity once we prove this pilot and get the response we're looking for.
Yeah, I've been involved personally in several CO2 floods, and I can tell you when they work, they're really good. I mean, like you said, it could quadruple your production pretty quick. And then once you start seeing it ramps up pretty quickly. So anyway, but the full field, you're only talking like 9 more of these sections or something. Now, would you have to build some kind of a special processing plant to extract the CO2, or can you just sell the whole raw stream? How does it work?
Well, kind of what we're looking at here is initially the raw stream is going to our midstream provider. Once we start getting significant volumes of CO2 back for recycle, we have a couple of options. One, we can re-inject the full stream. Blood, guts, and feathers is how they refer to that. And/or we can determine that we want to separate out the methane and Ngls, et cetera. So, and then a decision point. Do we try to unitize the entire unit for one big plant, or do you have kind of multiple small separation facilities? So, a lot on our plate here to determine the optimization of the project. But a 9,000 acre CO2 flood is a pretty good size unit. Considering Wasson's made up of about 7 units or something like that that's inside Wasson. So
yeah, that's good. Hey, how long have you guys been operating out there in that Champions play?
First well was drilled in 2015, end of 2015, early 16.
Yeah. Was it already a producing field and you just went in there? Or, I mean, there was existing wells, right?
No.
Oh, okay. Okay. Now, and it hasn't been, your acreage has not been water flooded?
Has not even been drilled for primary.
Oh, okay.
Basically, you'll see that the difference between us and Wasson is that we don't have quite the thickness of the main pay section. And the majority of our acreage would be considered a transition zone. And you're familiar with Seminole. I mean, Seminole started out where they flooded and CO2 flooded just the upper main pay section. And then they went in later and added the transition, or what they call the ROS. Some people refer to it as that, we don't. So we still have an extremely thick oil column with high oil saturations, enough to get primary production. But, it's not the same 2.3 billion barrel field that Lawson is, but it's several hundred million barrels of recoverable reserves.
Yeah. And just for the listener, I could tell you when we did the Seminole CO2 flood, once we started getting response and it ran up, we were getting big reserve revisions. The third-party engineers want to see that CO2 project works, and then when it does, they can give you some pretty significant proven reserve adds on it. So it can be a big catalyst for a company of this size.
Correct.
Anyway, okay, let's see. We talked about the hedges. You're going forward, probably going to use more collars, I guess, and then talk about the natural gas price, because I know you net out a lot of gathering and stuff there, and I think that's important for people to realize.
Yeah, sure. So I saw a question come in. Someone said, "Hey, I saw gas was under $2 last quarter." Actually, it was for the quarter we just reported. It was $3.20, and it was even over $2 the quarter before that. So it's $3.20 for this most recent quarter ended December 31. So that corresponds to an average of about 477 Henry Hub. So that implies about $1.57 in deducts. So the deducts, most of that is fees for the gas gathering and processing, which is netted out of the realized prices rather than down below and say costs. And that's consistent with how most companies report. And the fee isn't exactly fixed, as there's some small floating component type of pricing, but kind of that $1.60, $1.70, I think is reasonable for that. And then we had maybe negative 30 cents of basis differential. We're not Waha, we're up there. We don't easily tie to a certain hub, but that's about what it comes out to. So, when thinking about forecasting, if Henry Hub's in the $4 range, then we're hoping to net around maybe $2.25, maybe it's $1.80 of deducts or so.
Okay. And like you said, some companies show the gathering and processing as a separate expense line item, and you're netting it against the sales price to come up with your gas sales that are shown up in gross revenue. So anyway, just an accounting thing. Now Thomas asks, please explain in greater detail what the sources of CO2 could be. And you show the network of pipelines. Where do you expect to source your CO2?
Yeah, I can go first. So, first off, we signed an agreement with Kinder Morgan back in October, and that was for a couple things. It was for one, a tap, what we call a tap, that it's a physical tie-in to their pipeline system. And that pipeline runs straight through our property and frankly, straight through the actual unit where we're doing our EOR flood.
Oh God, that's perfect.
So, I mean, it's just incredible synergy there. So that's one agreement is for that. And then the other is actually for an offtake purchase agreement for natural CO2. And so that's coming down from Colorado, basically, as I was showing on this slide here. I don't know if you can see the little hand there. That's where we are. It's one of these that's coming down from one of their natural domes, is effectively where they have CO2 coming out of the ground, and we have a small agreement, or an agreement for a small amount of volume for a few years to get us started there. Going forward, we have the potential to switch to what we call anthropogenic or industrial CO2. Mm-hmm. We like the idea of doing that, in that you could take CO2 that's going into the atmosphere and stick it in the ground, and hopefully you're solving a couple of objectives there in removing it, that the world is asking for less CO2, and you're keeping it from going in the atmosphere. And then potentially, and we can't rep to this yet, but we hope there's an opportunity where you could get even less expensive CO2. that way. So anyway, that's something we're working on, and it's something to look forward to.
Yeah. And how much are you having to pay for the CO2 per MCF?
It's like the greater of maybe $1.50 per MCF or 2% of WTI. So right now it'll probably be a little bit above.
Yeah. And when I was at Hess, we calculated that it took 5 to 6 MCF of CO2 to push a barrel through. So
yeah.
Anyway, but then we started recycling. Once the field was fully developed with all the injection wells, then you're starting to recycle a lot of the CO2 anyway. So you're not buying as much more new. Then yes, Thomas asked again, do you have to approach prospects one by one to source the industrial CO2?
Yeah, there's a few ways you could do it. So you can go to an emitter one by one. You can say there's a certain plant, and then you say, I see you're along here in our region. It's efficient then for them to be pretty close to, or it's most efficient if they're close to one of these existing pipes. Say, even if they're 200 miles away, if they're 2 miles off the road of this pipe, then that's a lot less expensive than, say, if they're only 50 miles away, but 50 miles off the road of the pipe. Because then you're just building a shorter tie-in, and then you're paying a transport fee to Kinder or the others that own these common carrier pipelines. Maybe that's 30 cents or so. And then you can bring it back to your property. So that's one way you could do it. The other way we are considering is, do you use a partner from some of this, and you maybe split up the business and say, okay, well, maybe that guy wants to own the actual carbon capture equipment and is therefore eligible for the federal tax credit, which right now needs to be a credit to offset existing income taxes.
Right. And you guys aren't producing much taxable income at this point.
Right now we are not. We could in the future, but we're not. And so we would need some other way to do that. And the solar and wind guys have been doing this for years. And so what you do is go get tax equity financing, and that's possible, but they of course want their share. And so it starts to eat into the economics a little bit. So one option, and this was going to be potentially changed with that Build Back Better bill, among other things in there, was a direct pay component. And so we're trying to be flexible with what we have to work with now and how the legislation could change. But in any event, with the existing legislation and not having direct tax appetite, you could get a partner to own that, and maybe they take some amount of the economics, and it'd likely be, call it 3/4 or so in that case, with then us doing kind of a fee for service type of deal where we then take it after it's in the pipe and take care of the storage aspect of it.
Yeah, I'd say back
when
when
you're
we
doing
did
that, maybe you have one partner, you're not going one-to-one, and you kind of get some efficiency there.
Yeah, I'll tell you, back when we did Seminole, the reduction in our windfall profit tax because of the tertiary recovery project really almost paid for the entire project, just those tax credits. So they can be pretty nice. Nice deals.
And then I see Tom has a follow-on question. So to get the credit, you actually have to own the equipment.
Oh, okay.
And so it's called the 45Q of the tax code. You can Google and find lots of lawyer slides summarizing it. It's a higher credit. It's roughly $50 a ton or so for permanent storage, and about $35 for EOR. So you can actually get it for both. That you do have to own the equipment to get that, but that said, there's many ways to set up an economic sharing deal. So if somebody again owns it but knows they need a sink, a partner to put it somewhere, then you can strike a deal where they're paying you some fee to take care of the storage, even if you don't own anything.
Yeah, that's good. Then George asks that during the carbon injection, what percentage of the carbon remains in the well versus comes through in the oil flow?
Bobby, you want to comment on that? How much of the CO2 might come back up?
Yeah, so ultimately, at the end of the life, all of the CO2 stays in the ground.
Mhm.
However, in the initial stage, and you're going to remember this from Seminole, after a certain number of months, maybe 6 to 12 months, you start seeing CO2 returning at the wellhead, but it's a small percentage of what you're putting in. I would say it could get up to maybe 20 or 25% though, and you're recycling it and putting it back in the ground, which means you need less new CO2 to keep the same profile going. So, I don't know if I'm answering the question. I would say 100% in, maybe 20, 25% back for the first couple of years. Ultimately, end of cycle, all of the CO2 is sequestered at abandonment into the ground and not in the atmosphere.
Okay. And do you separate it at the property level?
We currently plan on on the pilot just to re-inject all of the gas until we get the exact numbers of what our recycle ratio is going to be. And then we will probably build a separation facility down the line so that we move the NGLs and gas down to the market and just recycle CO2. But the pilot just has us re-injecting all gas back into the formation.
Oh, okay. Okay. Oh, even the natural gas, right?
Yes. Yeah. Just on that unit, right?
Yeah.
Not across the field, but just on that 960 acre unit.
Okay. There's one more statement here from Thomas. Certain states pay more, like California. BBB is dead. I don't know what that means. Where's the opportunity to get paid for CO2 storage?
All right, so kind of three things in there. So yeah, I acknowledge California, it's LCFS, that's very big dollars. People look for ways to effectively get the fuel sold there so you can qualify for some of that money. I certainly acknowledge that exists. There's different ways you could possibly do that. One option is putting ammonia in, taking it out there for fuel. So aware of that, that takes some more complexity, but it's certainly things, people are trying to do. BBB is Build Back Better. That's the bill that is certainly dead. The one that Manchin was, resisting. That said, he helped write a lot of the 45Q section. So as they try to resurrect pieces of it, some people believe that there's more probability for, say, some of that to get resuscitated versus, free kindergarten or something.
Yeah.
The opportunity to get paid for CO2 storage, again, that would be a couple things. It could be, on a fee for service type of deal, where somebody wants to own the equipment and takes, say, 80% of the economics there, but they still need a sink to store the CO2 in, and we could be that sink, both for permanent or EOR storage. And so we could be collecting a fee then for storing that CO2 on our property. You could frankly do it other places too, if we wanted to operate that. That's the most obvious. We could also own the full value chain if we wanted to own the equipment and found a way to monetize the tax credits.
Yeah. And I tell you, like you show on your map there, West Texas has the best CO2 delivery network in probably the world. And any industrial producer of CO2, if they can, capture their CO2 and get it into those blue pipelines, they can get it over to Seminole.
Exactly. And I just want to further emphasize, some people say, well, you're not in the Gulf Coast. That's where all the big plants are, Houston corridor. But you really just have to be somewhere along that pipe. And so, look at that map. You could be in southeast of Utah there, southwest Colorado. You're right next to the pipe there, northwest New Mexico. You drop it in the pipe, we pay 30 cents, and there it is at our doorstep.
Yeah, so there's going to be this is going to be a big move. It's another one of our companies in our small cap growth portfolio, Talos Energy. They're doing a carbon capture project offshore.
Mississippi corridor, all that.
Yeah, right? Yeah. So it's a big deal. And then we used to follow Denbury. When I was at Hess, we sold our Mississippi assets to Denbury, and with that asset came a big source of CO2 in a buried volcano in northern Mississippi or something. And anyway, that was big business for them. Anyway, well, that's all I've got. You guys want to make some closing comments, and we'll go from there.
Bobby?
Well, I thank you guys for giving us the opportunity to present. You know, it's an exciting time for us. We've got a lot of great opportunities out there, not only with just the quality of the reservoir that we have, but, you know, we look at it as a world-class reservoir being conventional and so much oil in place. And we're trying to maximize the recovery, you know, so that's why we're looking beyond just primary development and production. But when you've got a resource this big, you really need to maximize how you get ultimate recovery out there. So that's kind of our story in a nutshell. We're in a great place, cheap finding costs, and an opportunity to really exploit recovery in the reservoir. So that's all I've got. If any of you guys want to finish up?
Yeah, I'll just add that I am going to update my forecast valuation model for the company and put it on the Energy Perspectives Group website today. Also here, I mean, I like that it's got net income already, free cash flow already, paying a dividend. You know, from there are very few of our small caps that we file pay dividends yet. So that's kind of unique to this one, but we're going to be following, we'll be updating our profile in the company every quarter from now on. And we'll just end it there. Philip, you need to say anything more?
No, I just appreciate the opportunity. Thanks for having us. Happy to, you know, continue a dialogue with the group, and enjoyed the first time talking to you.
All right. Thanks a lot. We'll get you up to Houston sometime for a luncheon or something. Anyway, Sabrina, why don't you go ahead and end it there? And we've recorded this and it'll be sent out to all of our global membership later today.